Most people think the danger begins when the market drops. I think the danger begins much earlier. It begins the day you believe cash is safety, that sitting still is prudence, and that a violent sell-off means the machine has broken. It usually has not broken. It is doing exactly what it was built to do. I have spent most of my life watching people stare at the smoke and miss the furnace. They look at war, oil, headlines, politicians, central banks, and they think that is the whole story. It is not. Those things matter, but they sit on top of something more powerful. Underneath all of it is a debt machine so large that it cannot tolerate long periods of falling asset prices, falling wages, falling tax receipts, or falling nominal growth. That is the game. If you do not understand that, you will keep reacting to every drop like the world is ending, and you will keep handing your future to people who understand the machine better than you do. I want to make this painfully simple. In a normal household, debt behaves one way. In a debt-soaked society, debt behaves another way. And if you mistake the second for the first, you will invest like a frightened amateur for the rest of your life. Picture a man with a $300,000 mortgage and a $100,000 salary. If his income drops to $70,000, the mortgage becomes heavier. Every payment feels larger. Every surprise becomes dangerous. Every month gets tighter. If his income rises to $150,000 while the debt stays fixed, the mortgage becomes lighter. The debt did not shrink. His income inflated around it. The burden changed because the denominator changed. Now enlarge that logic until it covers governments, consumers, corporations, banks, pension funds, leveraged investors, and the entire market structure. That is the first mechanism I want burned into your mind. I call it the debt engine. The debt engine is simple. When a society builds itself on mountains of debt, it develops an addiction to nominal growth. It needs prices rising. It needs wages rising. It needs tax collections rising. It needs asset values rising. It needs the appearance of progress because debts are serviced in nominal dollars, not in moral arguments and not in economic theory. That is why so many people misread the modern market. They think inflation is merely a policy mistake. It is often a pressure valve. They think money printing is some freak emergency response. It is often the rescue rope of a system that cannot survive prolonged deflation. They think markets should be allowed to reset naturally. Maybe they should, but should and will are not the same word. You can dislike the architecture. I often do. You can think it is unstable. It is. You can think it punishes savers who trust idle cash too much. It does. But the point of investing is not to pout at the machine. The point is to understand the machine well enough that it does not flatten you. And once you understand the debt engine, the next thing becomes obvious. When panic hits, everything can fall at once, even the things people swear are supposed to save them. That confuses ordinary investors. They say bonds are supposed to protect me. Gold is supposed to protect me. Cash flow companies are supposed to protect me. So why did they all get hit? Because in the middle of a real liquidity scramble, people do not sell what they dislike. They sell what they can. That is the second mechanism. I call it the margin trap. A market stuffed with leverage looks calm on the way up. It looks intelligent, efficient, even elegant. Borrowed money has a way of making foolishness look sophisticated for a little while. A man with $1 million can behave like he has $1.3 million. A fund with $1 billion can behave like it owns an empire. Everyone feels brilliant while prices rise. Borrowing feels justified. Prudence feels old-fashioned. Cash feels lazy. Then prices crack. Now the borrowed money becomes a leash. A broker does not care about your long-term thesis. A margin clerk does not admire your patience. A creditor does not reward your conviction. They want collateral. They want it quickly. And if you do not post it, they sell for you. That is why all asset sell-offs happen. Not because everyone suddenly changed their philosophy at the same time. Not because gold stopped being gold. Not because bonds forgot their job. Because people under pressure need cash. Now, I want you to picture a man who owns stocks on margin, some physical gold, maybe a rental property, maybe a few long-term positions he deeply believes in. If he gets hit with a margin call and needs liquidity in 48 hours, he is not listing the rental house and waiting for a clean closing. He is not negotiating with reality. He is dumping the liquid thing first. He sells the gold, he sells the bond fund, he sells the quality stock he promised himself he would never touch. He sells what the market will take immediately. That is not portfolio management, that is triage. And triage produces what I call the sell, anything panic. That is the third mechanism, the sell. Anything panic is when quality, junk, hedges, and hope all get thrown into the same chute because the problem is no longer valuation. The problem is liquidity. People outside the market always imagine that crashes are clean moral events where weak assets get punished and strong assets get rewarded. Real market stress is much uglier than that. In real stress, the market does not sort assets by virtue. It sorts them by saleability. That is why beginners get so disoriented. They look at an across-the-board drop and say, if everything is falling, nothing is safe. Wrong, it means something else. It means time horizons are colliding. The desperate seller is operating on hours. The serious investor should be operating on years. Those are not the same game. If you have no leverage, ample liquidity, and a clear mind, the sell. Anything panic can become one of the few moments in life when the market offers you honest bargains. Not because the future is clean, it never is, but because the short-term owner is being dragged by his throat while you are still standing upright. This is why I have always cared less about forecasting every headline and more about surviving the pressure points. I do not need to know the exact day fear peaks. I need to know what kind of system I am standing in, and we are standing in a system that, after each violent interruption, is strongly pulled back toward inflation, liquidity provision, asset support, and policy response. That does not mean there will never be pain. It means the pain has a direction. The fourth mechanism is what I call the inflation ladder. When the debt engine starts choking, the authorities do not normally choose prolonged deflation. They choose reflation. They choose stimulus. They choose accommodation. They choose some version of more money, easier conditions, bigger deficits, softer real obligations, and another attempt to drag the ladder upward under nominal prices. Why? Because the alternatives are politically poisonous. Deflation sounds clean in a textbook and brutal in a democracy. Falling wages are hated. Falling home values are hated. Falling tax collections are hated. Falling equity markets are hated. Debt defaults are hated. Bank failures are hated. So the system leans toward the thing that buys time. And the thing that buys time is almost always some form of reflation. Once you really absorb that, you stop asking the wrong question. You stop asking, will the authorities allow pain? Of course they will. Pain arrives first. The better question is, how long will they tolerate sustained deflationary pain before they step on the ladder again? Usually not very long. That is why I am so suspicious of investors who go completely cold every time market sees. They act as if the whole structure has flipped permanently. Maybe one day it will. Empires do age. Monetary systems do crack. But in the ordinary cycle, most people lose much more money preparing for a permanent collapse that never quite arrives than they lose from rationally owning productive assets through volatility. Now let me say something unfashionable. You do not need brilliance first. You need position. The market will not pay you for being emotionally intense. It will not pay you for being loudly bearish. It will not pay you for having the most dramatic theory in the room. It pays ownership over time, discipline under stress, and liquidity when others are starving for it. That brings me to the fifth mechanism. I call it the ownership filter. When the dust settles after a sell-off, not every asset recovers the same way. Junk can stay junk, fads can die, story stocks can vanish, but broad productive ownership, sensible diversification, and scarce real stores of value usually remain in the conversation because the system itself needs them. Think carefully about what that means. If the debt engine needs nominal growth, then broad equity ownership remains tied to that process. If the inflation ladder keeps getting used, then hard assets and real stores of value still have a role. If policy keeps trying to preserve financial conditions, then sitting entirely in idle cash becomes a strategy of slow surrender. This is why I do not like all or nothing thinking. A man who owns only growth stocks is fragile. A man who owns only gold is incomplete. A man who owns only cash is volunteering to be diluted. A man who owns only one country, one sector, one thesis, one political narrative, or one emergency story is making himself hostage to a single bridge. I want multiple bridges. I want productive businesses. I want broad market exposure. I want some exposure beyond one national story. I want some hard money insurance, and I want my life arranged so I never have to sell the good stuff because I got cute with leverage. That last point matters more than most people realize. There is no medal for using maximum borrowed money to reach your destination 6 months earlier. If the first real drawdown throws you out of the car, the market is full of people who were technically right and still went broke because they could not survive the timing. So if you ask me how to invest after a market drop in a debt-driven world, I am going to give you an answer many people find too simple. Stay invested. Add on weakness. Avoid excess leverage. Stay diversified. Keep some hard asset insurance. And never make a temporary liquidity event force a permanent mistake. Now I want to sharpen that. Staying invested does not mean staying asleep. It does not mean buying garbage. It does not mean pretending valuations never matter. It means understanding that in a world built on expanding debt, the long-term bias remains toward currency dilution and asset repricing, unless and until the system is deliberately allowed to break in earnest. I have not seen much appetite for that. When markets fall sharply, most people turn into bottom hunters or prophets. I am interested in neither costume. I prefer a repeatable process. I do not wait for the perfect bottom, because perfect bottoms are visible mainly in hindsight and in the fantasies of liars. I do not liquidate everything because headlines got louder. I do not try to jump in and out every week because activity feels intelligent. I buy in layers. That is how adults survive volatile systems. Call it dollar cost averaging if you like. I care less about the label than the behavior. If the market gives me a 10% sale, I buy some. If the sale becomes 15, I buy some more. If fear turns into a disorderly liquidation and quality gets marked down with nonsense, I buy again. The point is not heroics. The point is participation without self-destruction. You remove vanity from the process, and you remove the need to be clairvoyant. That also means you should think carefully about what you actually own. I like broad equity exposure because it is an ownership claim on enterprise itself. If the system requires nominal growth, taxes, revenue, and rising output, good businesses remain one of the cleanest ways to sit where the river eventually flows. I also like having some international exposure because concentration is comfortable until it becomes expensive. No single nation owns the future by divine right. Even if American enterprise remains unusually strong, I do not see wisdom in pretending the rest of the world is irrelevant. And I have no problem with gold and silver held in the right spirit. Not as lottery tickets, not as a religion, not as a substitute for ownership, as insurance. That distinction matters. Gold is not a business. It does not invent. It does not hire. It does not compound through retained earnings. But gold also does not ask permission from a politician to remain scarce. In a world of swelling money supply and repeated monetary rescue, I find it perfectly reasonable to hold some assets that remind you what a currency looks like when no one can print more of it over lunch. What I do not want is an investor who hears that and turns his whole life into a bunker portfolio. Fear can also become leverage. I have watched men overprotect themselves straight into mediocrity. They become so obsessed with the fire exit that they never enter the building where the wealth is created. I do not want that for you. I want you to understand the structure well enough to distinguish between a seizure and a funeral. Most sell-offs are seizures. They are violent, ugly, frightening, and expensive for the weak hand. They are not necessarily funerals. And there is one more trap I want to warn you about. Many people think diversification means owning a little bit of everything and then forgetting why they own any of it. That is not diversification. That is clutter. Real diversification is philosophical. You own productive compounding assets because the system wants nominal growth. You own some hard asset insurance because the system solves stress with dilution. You avoid excessive leverage because liquidity squeezes turn temporary declines into forced errors. You hold enough cash or near cash outside the market so you never have to raid your good assets at the worst possible time. And you keep buying in rational layers because volatility in a debt engine is not an exception. It is a feature. That is a complete logic. Now, let me take this one step further. A lot of people say, Warren, if the long-term direction is up because the debt system demands inflation, then why worry at all? Because path matters. A man can be directionally right and still be destroyed by sequence. If you lose your job into a downturn, sequence matters. Sequence matters. If you needed the money next year for a house, a wedding, medical bills, or tuition, sequence matters. That is why I hate lazy optimism almost as much as I hate lazy pessimism. The proper attitude is stern optimism with contingency planning. You do not need to become cheerful about instability. You need to become prepared for it. That is where identity changes. Most people still think like employees when they invest. They think their job is to react correctly to the news. That is not the job. The job is to think like an owner inside a manipulated debt-dependent inflation-prone system and to act from a prepared operating framework rather than from pulse rate. That is the identity flip. You are not a spectator of the market. You are a capital allocator. And capital allocators do not spend their days asking, how do I feel about this week? They ask, what kind of machine is this? Where is pressure building? What assets survive the pressure? And how do I position so fear improves my long-term return instead of destroying it? If you can make that shift, you stop being easy prey. Now I want to leave you with the protocol I would actually use. First, keep a real emergency reserve outside your investment portfolio. Not because cash is king forever, it is not, but because cash is the oxygen that prevents forced selling. Emergency cash is not an investment return decision. It is a behavioral survival tool. Second, ban reckless leverage from your life. If you borrow modestly for practical purposes, fine. But if your plan requires a rising market every month to remain stable, your plan is not a plan. It is a hostage note. Third, keep automatic buying alive. If the market drops, your process should not disappear. It should become more useful. Automatic buying turns fear into inventory accumulation. Fourth, favor broad productive ownership for the core of your wealth. The more the system leans on growth, liquidity, and reflation, the more valuable sensible ownership becomes. Fifth, add selective non-dollar or hard asset insurance, not as drama as ballast. Sixth, never let a 2-week panic rewrite a 20-year thesis unless the underlying business reality truly changed. Price is not always signal. Sometimes it is just distress in costume. Seventh, review your life for hidden leverage. A giant car payment is leverage. Too much variable rate debt is leverage. Living at the absolute edge of your income is leverage. A fragile personal balance sheet will sabotage a strong investment philosophy. Eighth, remember what actually compounds, not adrenaline, not prediction, ownership. That is the protocol. And if you follow it, you do not need to fear every market break. You may not enjoy them, I do not, but you will understand them well enough to act with discipline while others act with desperation. Let me say this as plainly as I can. In the years ahead, you are going to hear smarter sounding people than me tell you to do something complicated. They will tell you to rotate here, hedge there, short this, trade that, time this geopolitical path, front-run that central bank, and optimize your exposure to every twitch in the macro weather. Some of them will sound brilliant. A few will even get lucky. But most fortunes are not built by winning every weather forecast. They are built by owning the right things through a climate that was designed to devalue passivity and reward durable ownership. That is why I do not panic when I see broad liquidations. I look for leverage, I look for forced sellers, I look for whether the system is choking or dying. And I remember that a debt bubble cannot live on honesty for very long. It lives on growth, inflation, liquidity, and time. So I invest accordingly. If you leave this with only one thought, let it be this. When the market falls in a debt-driven world, do not ask first, what headline caused this? Ask, who is being forced to sell? What does the system and which assets sit closest to that need? That question will make you much richer than the headline ever will. The people who win are usually not the ones who predict every crisis. They are the ones who understand the machine well enough to buy sound ownership, while everyone else is mistaking a liquidity seizure for the end of the world. That is how wealth gets transferred. That is how panic gets monetized. And that is how you stop being the one who funds other people's bargains. One last thing, people love the phrase safe haven because it sounds final. There is no final haven inside a leverage system. There is only relative strength, time horizon, and the difference between an asset that can survive the next squeeze and a person who cannot. That is why I care so much about behavior. A frightened investor with a good portfolio can still lose. A disciplined investor with an ordinary portfolio can still do very well. The market does not just test what you own. It tests whether you deserve to keep owning it. If a 10% decline can chase you out, your real problem was never the decline. It was the story you were telling yourself about risk. If a margin call can make you dump your best assets, your real problem was never volatility. It was leverage dressed up as confidence. If you need every month to be smooth, your real problem was never the market. It was a fragile life built on the assumption that the future would arrive on schedule. I do not want you fragile. I want you liquid, patient, diversified, and hard to shake loose, because the next drop will come, and the one after that will come too. There will be another war scare, another debt scare, another recession scare, another inflation scare, another banking scare, another commodity spike, another chorus telling you this time is different and ownership is dead. And almost every time, the same people will make the same mistake. They will sell productive assets to feel immediate relief. They will trade a permanent claim on future growth for temporary emotional comfort. They will call that prudence. I call it surrender. The knife, edge truth is simple. In this kind of world, cash calms you, but ownership carries you. So keep enough cash to stay calm. Then keep buying ownership while frightened. People keep donating it to the patient.